Let's apply the concept of short selling within a finance case studies, specifically utilizing the Finance Research Gate website. For our demonstration, I'll be using both a single frequency and an annual frequency as illustrative examples. Let's take, for instance, our specific data sample will have to commence in the year 1996 and then extend all the way through to the year 2024. Just to make certain that we possess a sufficiently large and representative set of observations dating from before 1996, we do in fact have a few. By the year 2025, we still hadn't managed to finish gathering all the required observations from every single firm. First, we need to define and apply the specific time period we're interested in, and subsequently, we'll proceed to carefully select our independent or X variables. For the purpose of this demonstration, I will be using the annual market return as a clear and straightforward example. So, we are going to deal with the time series case at the market level. The X variables will be chosen based on the Welch and Goyal study from 2008, published in the Review of Financial Studies. So, I'll be selecting a number of variables. The net amount of new stock issued, which caused a lot of surprise, from book to market. And we can have investment ratio, investment to asset, the asset itself. The Y variable for our analysis is the stock return. What we're presenting here is the data at the individual firm level, but the short will then aggregate all of it at the overall market level. So we start with the panel firm data, but then later we'll aggregate it. The very first step I'm going to take is to apply a lag to these specific variables. So I'll be lagging every single X variable in our data set just to ensure that we can confidently establish a reasonable causality impact. And then I'm going to add the necessary lags right here. And then, as a crucial step, I'm going to perform a single standardization. This is so we can effectively avoid any extreme observations that might skew our results. Even though we are going to aggregate all firms' data in each year, this approach will still allow us to significantly limit the overall effect of any potential outliers. However, if we encounter very extreme data points or values, these will significantly distort our overall market level variable, especially impacting the calculated annual market return. Therefore, to ensure accuracy, we should implement a standardization process. And let's go ahead and select all of the variables. It's important to remember we're now dealing with the lag of the X variable. And regarding Y, which signifies the annual stock return, our objective is to incrementally raise each individual variable by precisely 1%. And then we are going to be making them. Alright, we are now fully prepared to start this brief section. If you scroll down just a little bit here, you'll find the time series section, where on the X-axis we're going to be representing the year, and on the Y-axis we can display a whole range of different variables. Now don't forget that we intend to raise the Y-axis value, so we have to implement it here. And by implementing this process, the short position will then collect and combine the annual financial returns for every individual firm, considering all companies within each respective year. So each individual point displayed here actually represents the average, specifically the cross-sectional mean of the annual financial returns. Consequently, we have a unique data point available for every single year. Now, you have the option to incorporate multiple variables, or truly as many as you desire. For example, we could include dividend yield, earnings per price, and other similar metrics. But for this specific demonstration, I will, of course, be using the straightforward 1.1 rise variable. This means that the influence of those extreme data points or outliers will be significantly reduced. So when I perform this action, I'm able to display multiple lines quite easily in this space. You could even incorporate additional lines, but we will undoubtedly face a significant scale problem. Some variables might be on a different scale, and as a result, they might not appear clear visually. For instance, I might choose to eliminate the Y variable and instead retain the dividend yield and the earnings yield because they share a more comparable scale, which will ultimately make the chart much clearer to understand. Of course, it's crucial to keep in mind that we possess the complete freedom to assign specific name to these variables exactly as they are presented to us here. For example, if our Y variable happens to represent the annual return on an investment, then we can explicitly designate it as annual return within our current setup. I'm going to make that particular change right now. Regarding the X, let's keep it right here. That certainly makes perfect sense. Let me get back to the main dependent variable, the 1-to-1's annual market return. And here we're presented with a variety of different graphical shapes. For example, you can choose to display the data as a continuous line but without the individual points. Alternatively, you might prefer to see just the discrete data points themselves. And finally, another common option is to show the data in the form of vertical bars.
And many more things. I think I'll go with the default one, specifically the line and points.
And now, let's move on to conducting the event study.
So in the event study, we are going to examine the effect of the event on the annual market return. So let's enable this. Now the control variables, these are the independent X variables that we will be utilizing to calculate the predicted annual return, which we designate as our Y variable. Consequently, in this particular situation, we are going to make use of as many variables as we desire. However, it is crucial that we emphasize this particular point. Our analysis involves data points collected on an annual basis. Consequently, we have a rather limited number of observations available to us. So here, within this designated pre-event window, you are able to decide the precise number of years that we will employ to conduct an OLS regression analysis of the Y variable, which in this specific instance is the annual return against the X variables. So if you are going to use 5 years, we have 5 observations. If using 4 or even 5 or perhaps more variables simply won't be practical. We absolutely need to maintain sufficient degrees of freedom to ensure we can calculate a truly reliable coefficient. So in this specific case, I'll increase that value to 10. And for now, let's just stick with maybe 2 variables.
Let me choose something like the dividend yield, for example, and the earnings price ratio.
The post-event observation window is what will ultimately determine the specific number of years you intend to thoroughly examine the return behavior following the initial event year. So let's also consider a time frame 10 years after a specific event. And then, of course, we'll also look at the period 10 years before that same important occurrence. So what year do you think should be our central event year? Pick any year that you feel marked a truly significant moment.
In 2008, for example, we experienced the global financial crisis, and that certainly provides a strong example.
So let me remove these.
We need to adjust these texts so that the chart is clearly visible and unobstructed. So you have the ability to zoom in and out of the view using this specific control. And you can also download the content by clicking on these 3 distinct dots, which will then allow you to save it. Now, if you look closely here, you can clearly observe the annual market return. This particular line, the one that is distinctly dotted, represents the expected value, which has been carefully calculated by utilizing 2 important variables, the dividend yield and the earnings yield. And you can clearly observe that the projected value remains quite stable. Therefore, any observed fluctuation in this area must primarily be attributed to the specific events that occurred. If we look at the year of financial crises, we observed a period of significantly low market value. Then, considering the end of 2022, we faced the COVID-19 pandemic and its widespread impact, which lasted until that year's close. Following this challenging period, the market then started its recovery process. However, we did identify several truly significant factors and observable effects that can provide a comprehensive explanation for precisely why the overall annual market return ultimately diverged so very substantially from the originally anticipated forecast value. Okay, looking at this chart, you can easily zoom in for more detail. That will tell you the abnormal return, defined as the difference between the actual annual market return and the predicted value. So if you have a good model and there's no deviation from it, that should be a 0 in almost every period. However, it is natural that we observe deviations. This is because, as with any predictive model, the actual observed value will inevitably diverge from the initial expected forecast. This divergence is primarily driven by a multitude of significant macroeconomic events. So if you're interested in seeing how the relationship evolves over time, when looking at the relationship between the annual return and the selected regressors, you're able to select this specific option, Show Break at Event. This will indicate whether the specific event truly brought about a shift in the underlying relationship. So if we conduct an OLS regression analysis before the year 2008, which is our key event, and then again after it, we need to determine if the resulting coefficients show a significant difference. That test is indicating a negative outcome because the underlying relationship has remained stable and the coefficients have not changed significantly. So we can still confidently use that model to determine the predicted value.
I'm not claiming that this specific model is the one and only perfect solution we could ever find. What I'm emphasizing is that the specific model we carefully selected for this situation did not undergo any substantial changes following the occurrence of the event. I'm also not suggesting that the annual return didn't undergo a significant alteration after the event. It certainly did change, as we previously observed a notable decline, followed by a subsequent recovery. What we're saying here, to be clear, is that this particular model demonstrates a consistent and reliable stability when it comes to explaining the annual rate of return. One of the other things that you are able to do within this section is to examine whether we have a cumulative abnormal return that follows the specific event. Therefore, if you choose to select this option, it will then present you with this particular chart. So, the primary impact we're discussing is that this particular event, specifically the global financial crisis, actually led to a significant negative annual return for a certain duration within that entire decade. Are these findings significant? Well, to determine that, we can examine the difference in difference approach. This means we're essentially comparing the discrepancy between the actual observed values and what we had predicted. This discrepancy, as we previously termed it, is what we refer to as abnormal. So in essence, we are comparing these abnormal values, the returns observed after the event and the abnormal returns prior to the event. Do these results show statistical significance? They are not significant, as the p-value is greater than 5%. So in addition to that, we also have the option of selecting and marking those years that are truly significant. However, in this particular situation, we might not experience many significant years after the event. We can, however, observe substantial movements and the overall trend. So it's important to note that following the event, there was a rapid recovery. So looking at the long term, over a period of 10 years, on average, we might not experience such a significant negative return. Instead, we could see a significant positive return, perhaps within 1 or 2 years after the event, allowing you to adjust the time frame as necessary. So in this very same spot, you're also able to make all the necessary adjustments to the event. If you want to conduct a placebo test, for instance, you could change the event here to a year that didn't experience any significant occurrences, simply to compare the outcomes between the actual event and the simulated one. This is an exercise you can perform.
So after having completed all of that work,
So what you're able to do is study the annual return behavior, or perhaps any other wide variable behavior. The last thing I have to mention here is the annotations. And if you want to jot down any kind of information, let's just imagine you'd like to add a specific note right here, perhaps concerning the year 2008. Maybe you'd want to inform the reader that we experienced a rather significant global financial crisis back then. You can simply pinpoint this exact location and clearly write down 2008 for reference. Let's say that you want to also write yourself a note considering the period around 2022 with the COVID-19 pandemic. You could easily add yet another year to this time frame, and then we are going to have lines. We need to display vertical lines, which will precisely correspond to the specific year that has been chosen within this designated input box. And then you can write a note. For example, in this section, you can specify the year, such as 2008, and for that, you'll need to provide specific coordinates. If you wish to input any information, you'll require a precise coordinate, both the x and the y values. So in our case, we've already determined the x value to be 2008. For instance, let's consider that we'd like to place this information right here in this particular spot. So the value we have here is negative 0.288. That's negative 0.288 minus 0.288. So right here, we're looking at the specific year, 2008. And then once you've successfully determined the exact coordinate, you'll be able to formulate and write out the full description. For example, we could use the word global.
Global financial crisis.
And that should be the final section of the chart. One of the panels that's worth discussing as the variance, and we can talk about it right here. So, what you should really be focusing on, particularly after an abnormal situation, is not the simple return, nor the absolute value, but rather the underlying variance. At this specific point, the variance changed and went up. So, despite the fact that the model demonstrates stability in its predictions of the annual return, and irrespective of whether that model was initially considered significant for such predictions, its stability was clearly shown by the results of the shower break event test. However, the inherent variability, specifically the variance associated with that unusual abnormal return, has significantly increased. Consequently, its current level is considerably higher than it was before.
Now, it's certainly worth mentioning that this chart will prove invaluable in helping you to clearly visualize all the relevant variables, allowing you to readily detect significant events, crucial years, and naturally, the most impactful variables. And this information will be quite helpful for you when you are revising your study, perhaps by incorporating some additional robustness tests.
Thank you for watching. If you have any questions, please let us know.